to Talking About Finance. My name is Dave Coker. As usual, 7 slides, what I just happened to see going on over the past week. So, institutional money on USD. This is particularly interesting because we've looked at this chart before. We can see that institutional money is setting up their positions such that they'll benefit from a weaker dollar. In other words, they're a little skeptical that the dollar will remain as strong as it is now or as strong as it has historically been. So they're positioning assets such that as the dollar continues to decline, we've seen some weakness, they'll be able to profit. Well, not to worry about this because the government's going to be able to help. And we'll look at this over the next couple of weeks. Here I've got the marginal tax rate for individuals. And then I've got federal debt. So, excuse me, black line is personal marginal tax rate. And the red line is federal debt as a percentage of GDP. Clearly, and as we've spoken about before, clearly the percentage of debt as a function of GDP is soaring. It's at unprecedented levels. There's lots of different ways you can measure this, but regardless, they're all pointing the same way, up. Taxes, however, you can see since the 70s, the highest marginal tax rate in the 70s was roughly 75%, 77%, I think it topped out at. And then it started to drop, and we saw it drop really low down to 1990. Highest rate was about 28%, and up to the present. Well, guys, there's only one way that we're going to get out of this problem. We can't get the debt, wish the debt away. Fantasies about a debt jamboree are just that. The U.S. will not default on their debt. So they've done this before. We're going to see taxes soar. It's the easy way out. And there'll be all sorts of snarling about pay your fair share, things like that. It's going to be a little nasty. We're starting to see signs of inflation. Here's an interesting one that I just found out about. Lumber prices soaring, some 16% year on year. How bad is it? Well, cut lumber, the actual price that entities pay to acquire lumber, has risen about 1,000% over the past year. It's really wild how this is shooting up. Now, this has gotten so bad that industry, and this won't surprise you, I have to tell you, this is really wild. Industry is actually asking for a bailout. Yeah, everybody wants to get paid by the government, and we'll have to see how far that goes. I'm not sure they've got the traction, but this is going to ripple through the broader economy. It starts with these commodities, and it continues to persist. We can see it in different series. Here I've got the global price of tin, copper, iron ore, and I've got silver. And what I'm doing is I'm looking back every month. I'm looking at year-on-year changes. Now, a couple things to point out, guys. The industrial use of tin, copper, and iron ore is obvious. Silver, it's a mixed metal. It's not like gold. Gold largely is investment or jewelry. Silver, of course, we do have demand for investment. I own a great deal of silver myself. We do have some demand for jewelry. I don't really own any jewelry or give any. Well, I guess I give the wife jewelry from time to time that's made out of sterling silver. But the point is this: the greater bulk, about 60% of the use of silver, is industrial. And so we see it soaring as well. It's really interesting to take a look at that we're starting to see signs of inflation across different time series, different data points. And it's likely to get worse as the government continues to print money. What about big tech? That was the safe haven for quite a while. Well, got whacked, got spanked pretty hard over the past few trading sessions. We can see that they're starting to diverge, and commodities are actually running up pretty well. Here I've got over the past, this is actually 3 months. What we're looking at here is we're looking at the series. It's baselined at 0, and we're looking at the performance of each series over time. Commodities since November 2020, up some 22.5%. Tech is up 11.24. S&P 500, the benchmark up roughly 9%, 8.97. So you're still doing pretty well if you pushed your money into tech. However, commodities are breaking out at this point, and we'll watch this carefully to see if this continues. Of course, I'm positioned well, and I've spoken with you guys about this. I've been advising people for a while now. Buy gold, silver, property, tangible, real, physical assets, in other words. Oh, and Bitcoin for fun. We're starting to see treasuries move, particularly at the long end. Now, what I've got here is a construction that we look at. We're trying to get an idea about the steepness of the yield curve. Keep in mind the yield curve, otherwise known as the term structure of interest rates, measures benchmark U.S. government yields across various tenors. So visualize it in your mind. From the left side, we've got 1 month T-bills. We've got 3-month T-bills, 6-month T-bills, 12-month or 1-year T-bills. And then we ripple through the remaining tenors, 2-year, 3-year, 5-year, 7-year, 10-year notes. Then we got 20 and 30-year rounding out the presentation. So we're starting to look at we're looking here, I should say, at the difference. We take the 10-year yield and from it we subtract the 2-year yield. And it's really interesting, guys, to get a look at this. You can see it's starting to widen, starting to steepen. The yields are changing. And because of this, you want to start to think about where you're going to position your money to profit from this. Now, historically, industries, I should say, that do well from a steepening yield curve, one big component or one big target are financials. So take a look at bank stocks. It's probably a good time to move in. I did this same type of trade back in after the global financial crisis and did very well with Bank of America. I don't hold a position in any banks now. I've got other things going on, but it's actually pretty good to think about and to start positioning assets so that you'll make money as the economy continues to recover. And we talked last week about housing. Specifically, we talked about how houses in the United States have never been more affordable as a function of percentage of disposable income. And this was in the New York Times, I believe, on Monday. Really wild. Part of the reason why house prices are hitting record highs in the States, of course, that lumber story that broke yesterday might have something to do with it, but the supply of homes for sale has dropped significantly. Look at some of these areas. From Atlanta, went from roughly 20,000 homes going back to 2017 down to below 10,000, coming in at roughly 9,000 homes. Same thing in Austin, Chicago, New York. All these areas are seeing the supply of homes for sale drop significantly. Really simple explanation for it. Interest rates have never been so low. And if you're getting married, for instance, and each of you own a home, it's optimal to maintain your existing home and rent it out. In other words, hold on to it, rent it out. You're paying record low interest rates, record low mortgage rates. And it's pretty relatively easy to make money in that type of business. Of course, I'm in property. I don't leverage like that. I do cash deals. So there's a lot more to property than just cheap funding. It's a whole business that they'll have to learn. But I wish them well, genuinely. But that's a big factor. People are just holding on to their homes more. And even people that, for instance, they're living in their home and they decide to move for whatever reason. Again, if they've got a mortgage, the funding is very cheap, so they just hold on to it. And we've never really seen that behavior before. I'm going to follow up. I've got the data. Next week, we'll look at the number of families or households that own more than one home. And you might be surprised at some of these numbers. It's absolutely amazing. All right, guys, that's it for this week. As I said, 7 slides, 7 days, just some stuff that I'm seeing in the markets. Take care.